Hey, before you buy your next stock, why not try to destroy it first? That may sound backwards, but it's what many smart investors do. And I'm about to show you how AI can help you do this in 5 minutes for free. But first, what's up? I'm Russ. I am a blue-collar welder, so this is not financial advice. These are just my thoughts and opinions for fun and entertainment, and I am passionate about passive investing and very close to being a net worth millionaire. So here's what usually happens when we research a stock. You read about why it's great, you get excited, you see the stock price going up, and you imagine making lots of money. And then you kind of ignore all the warning signs because you've already convinced yourself that you've bought a winner. That's called confirmation bias, and it can cost us a lot of money. Believe me, I know. Many professional investors flip that around, and before they invest, they try to destroy their own idea by asking, what am I missing? What could go wrong? And if they can't find very many good reasons why the investment might fail, then they confidently start a position. But the problem is, many of us don't know how to do this because we're retail investors. We are not professional skeptics, and that's where AI comes in. Now, AI is not perfect, and it obviously can make mistakes, and it most certainly cannot predict the future. It can act like a professional short seller and attack your stock idea from multiple angles, and it's fast, it's free, and it forces you to see risks you might have ignored, and we're gonna see exactly how this works. So here I'm using the free version of ChatGPT, but this will work with any AI chatbot. And I've added a simple prompt to the description that you can copy and paste, and all you have to do is add your stock and ticker. So for this demo, I'm using a stock I used to own, SBUX, ticker SBUX, because it's a dividend stock that many investors own or are watching right now. And I also have a link below to this chat. So here's what I asked ChatGPT. You are a professional short seller analyzing SBUX, ticker SBUX. Your job is to build a bear case, find everything that could go wrong with this investment. Create a simple short report written at an 8th grade reading level. Please provide 1. The top 5 risks or problems that could cause this stock to drop 30 to 50%. 2. A letter grade A through F for how easy this stock would be to short. A would be easier to short, and D or F means it's a strong company and it would be harder to short. And to be brutally honest, and I want to see the risks clearly. So I hit enter, and here's what it gave me. And this was pretty cool. It started with an interactive chart showing that yes, the stock has been struggling. Then it broke down the analysis and gave a grade of B, which meant it is easier to short, which is not what most people expect from SBUX. And here are the 5 major risks that it found. First is margin squeeze, meaning labor costs are up, coffee beans are more expensive, profits are shrinking. Second, declining customers, meaning that the same store sales are dropping because people are going elsewhere. Third is their debt, which they're carrying a lot of it with high interest costs. Fourth, they have labor problems, which are union strikes, wage demands, and operational disruptions. And fifth is stiffening competition from local cafes and cheaper alternatives that have been winning lately. So for dividend investors, this is critical because problems like these can lead to a dividend cut. I had a couple follow-up questions that I suggest you do too, and the first one was I asked, what are the top 3 red flags I should watch quarterly? Red flag number 1 that ChatGPT gave me was if sales at existing stores keep falling, especially in the US and China, it means that customers are leaving, and that is the biggest warning sign. The second red flag is that if their profit margin keeps shrinking because their costs are rising faster than prices, earnings are going to collapse, and you should watch for this trend over 2 to 3 quarters. And red flag number 3 is that if they're borrowing more money while generating less cash, that's a dangerous combination, especially when they still have to pay those dividends. And all of this will show up in their quarterly earnings report. And the second follow-up question, and what is really important for dividend investors, is what signs would tell me the dividend is at risk of being cut? And it gave me 5 warning signs, but here are the big 3. free. A payout ratio over 70%, which means if they're paying out more than 70% of their earnings as dividends, there's little safety margin. And over 90%, the dividend is in real danger. And this checks out because as of the last 12 months, their earnings payout ratio is 116%. But remember, the dividend comes from cash flow, which I think is more important. And that has been at 114%. So that has to come down and come down quick, which is what warning number 2 was, is that the free cash flow is falling below the dividend payment, which it is right now, because again, dividends are paid with actual cash, not accounting profits, which is earnings per share. So if that cash flow stays below what they're paying out, something is going to have to give, and it's going to be the dividend. And then the third biggest was the management language changing, so you should listen for phrases like reallocating capital or optimizing the balance sheet, which are code words that often come a few quarters or maybe even a year or two before a dividend cut. And then ChatGPT even gave me a simple rule which said if cash flow is less than dividends for more than 2 quarters, risk is high. And then it even offered to build a Starbucks dividend safety dashboard to use every quarter, which it said would make simple, color-coded, and built for us dividend investors. So with the link below, I've made this whole conversation public. Feel free to check it out and study it. So what I learned in about 5 minutes and for free is that Starbucks is not the safe dividend stock that it used to be. That the easier to short grade B and all the red flags that ChatGPT gave me, I would agree with from the research that I had done previously. And does it mean to sell immediately? It does not. But those are red flags that you have to be aware of, and you have to make the decision if you think Starbucks can overcome them with the dividend intact. So for this example with Starbucks, I would watch those quarterly numbers closely. Don't assume the dividend is safe forever. Be ready to act if things get worse, and consider potentially reducing your position size. Or if you're confident that it's going to navigate all of these headwinds, could be a great time to buy. But the point is that AI helped me see these risks a lot clearly and easily, and that's worth a lot. And if you'd like to see what I'm buying or selling every day, follow my portfolio as well as other investors you know and love like Ryan Williams and Ian Lopik, and connect with a great community, I would encourage you to use my Blossom link to sign up for free. And hey, I'll even get a few extra bucks sent my way from the Blossom team at no extra cost to you. And I also have a free and fantabulous weekly newsletter that's easy to read with some interesting investing ideas, the latest portfolio moves, and some notable stocks about to go ex-dividend in the coming week. Remember, AI is not giving you financial advice. It's showing you the other side, what a short seller sees. And as always, it's still on you to make the final decision. But being more educated and aware of potential risks and red flags before you invest is priceless. Hey, we'd love to know in the comments below if you have used AI to identify potential risks of any investments. And in this floating little box next to my head, YouTube handpicked a video just for you. So you'll probably be a much smarter investor if you click this floating little box next to my head, and we will see you in the next one.